I was about to go into my trading room one day, and I noticed something was off. The door was open. Now, I'm very sure I closed it, so I took a peek inside, and what I saw did not make sense. There was a random guy sitting at my setup using his own voice to record my YouTube videos. At that point, I had questions, a lot of questions. So I stepped in. He turned around, and let's just say he wasn't expecting me. I confronted him, and immediately he started apologizing, saying things like, "I'm sorry, I didn't think you were coming back." Yeah, neither did I. So I handled it, made him hold up a sign, "Chart Tactics is back." And just like that, everything is back under control. So in this video, I'm going to break down everything you need to know: what a balanced price range is, how it forms, and most importantly, how to actually use it effectively on the chart. Because once you understand this, your entries become a lot more precise. Now, what is a balanced price range? A balanced price range is simply the overlap between two fair value gaps. But not just any two. One of those fair value gaps has to be disrespected, which turns it into an inverse fair value gap. Then, price creates a new fair value gap that overlaps with that inverse one. So, in simple terms, a balanced price range is the combination of an inverse fair value gap and a new fair value gap forming into it. That overlap is what we call balanced price range. Now let's look at a graphical representation of this. First, price creates a bearish fair value gap. Then price pushes up and disrespects that gap. Once that happens, that bearish fair value gap becomes an inverse fair value gap. After that, price forms a bullish fair value gap around that same area. Now you have overlap. You have the inverse bearish fair value gap and the bullish fair value gap. Right in between them, that is your balanced price range. And the same thing applies in the opposite direction. You can have a bullish fair value gap, price pushes down, disrespects it, turning it into an inverse fair value gap. Then price forms a bearish fair value gap that overlaps with it. And once again, that overlap becomes your balanced price range. Now here's the important part. This concept is actually stronger than just a normal fair value gap, or even just an inverse fair value gap, because it combines both ideas into one level. You're seeing a zone where price has interacted from both sides. Price has moved aggressively, then returned, and created balance. And when we have that, what we expect is for price to come back into that level, retest it, and then continue moving in its original direction. That's not random. That is a decision point in the market. But here's where most traders get it wrong. They see a balanced price range, and they try to trade every single one. That doesn't work. You need context. You need confirmation. Now, what I mean by context and confirmation is this. Other confluences need to back up your balanced price range. If not, it's just a pattern. You don't want to be trading patterns. You want to be trading stories. So the balanced price range you want to trade needs to have reasons behind it. It needs to make sense within the market structure. Now, it doesn't really matter what confluences you decide to use. It could be liquidity, it could be market structure, it could be higher time frame bias. But the key thing is this. Make sure your setup has confluence, because that's what increases your probability. But for this video, we'll focus on how to actually use balanced price range with a very strong confluence. And in this case, we're going to be using liquidity sweeps. So this is the model you want to follow. Let's start with a bullish scenario. First, you want to see a sweep of sell-side liquidity. Price takes out previous lows and grabs liquidity. After that, you want to see price move away from that area aggressively, an impulsive move to the upside. Now here's the important part. That move should disrespect the last bearish fair value gap and at the same time, create a bullish fair value gap. At this point, you should now have your balanced price range forming, because you now have the overlap between the inverse fair value gap and the newly created one. So what do? You don't chase price. You wait. You allow price to come back into that balanced price range. That's where you look to take your entry. You can place your limit order there or wait for confirmation on a lower time frame. Your stop loss goes below the swing low. And your target, keep it simple. Aim for at least a 1 to 2 risk to reward. Now let's look at the opposite side, the bearish scenario. First, you want to see a sweep of buy-side liquidity. Price takes out previous highs and grabs liquidity. After that, you want to see price move away from that area aggressively. An impulsive move to the downside. Now here's the important part. That move should disrespect the last bullish fair value gap and at the same time create a bearish fair value gap. At this point, you should now have your balanced price range forming. Again, from the overlap between the inverse fair value gap and the newly created one. Same idea here. You don't chase price. You wait for price to retrace back into that zone. That's where you look for your entry. Your stop loss goes above the swing high. And your target, again, aim for at least a 1 to 2. So let's go to the charts, and I'll show you real examples of this model and how price consistently returns to those areas and reacts from them. So this is the first example we're going to talk about. First of all, we can see a sweep of sell-side liquidity. Price takes out the previous lows and grabs liquidity. After that, we can see that price left behind this fair value gap. And immediately after that, we saw an impulsive move to the upside. Now here's the key part. That move disrespected the bearish fair value gap and at the same time left behind a bullish fair value gap. Now we have overlap, and that overlap becomes our balanced price range. So what are we going to do here? We wait. We allow price to come back into that level, and then we look to take our entry from there. Our stop loss goes below the swing low, and for our target, we keep it simple. We aim for a 1 to 2 risk to reward. Now, let's play price forward and see how this trade played out. And as you can see, this trade actually hit stop loss. Now, the reason I'm showing you this is to make something very clear. Even if you have a balanced price range, a liquidity sweep, and even a higher time frame bias, you can still lose the trade. This is not a holy grail. There is no strategy in trading that wins 100% of the time. So always keep that in mind. But now, let's look at some other examples that actually played out very well. So you can also see how powerful this model can be when everything aligns properly. Now, let's look at the next example. This one is very important because this is where what I talked about earlier, context, will make more sense to you. This balanced price range had more context behind it. And that's exactly why this trade played out cleanly. So first of all, we can see a sweep of buy-side liquidity. Price took out the previous high and grabs liquidity. Now, not just that, right at that sweep, we can also see that price reacted from a bearish fair value gap. So already, we're building confluence. Then after the sweep, we see a push to the downside, an impulsive move that gives us a break of structure. Now it gets even better. We can also see that the last bullish fair value gap was disrespected, and at the same time, price created a bearish fair value gap. Now we have the overlap, and that overlap becomes our balanced price range. So what do we do in this case? This is where execution comes in. We can set our limit order right at that balanced price range. Our stop loss goes just above the high, and for our target, we aim for a 1 to 2 risk to reward. Now, let's see how this played out. As you can see, just within one candle, price hit our take profit. Now, this is exactly why I said having context is very important. Because in this example, we didn't just have a balanced price range. We had a liquidity sweep, a reaction from a fair value gap, a break of structure, and a clear displacement. That's a full story. And when your setup has that kind of story behind it, your probability increases. You can see how price came back into the balanced price range and almost immediately reacted strongly to the downside. That's the difference. Let's look at another example. So this is going to be our last example. And this one is also very interesting because it actually happened just a day after the previous example. Now again, this is where context really comes into play. This setup had a lot of context behind it, and that's why it works so cleanly. So first of all, we can see a sweep of buy-side liquidity. Price took out the previous high. Not just that, we can also see that price was reacting from a balanced price range. So already, we have confluences signifying a bearishness. After that, we saw price move to the downside, an impulsive move. Now here's the key part. That move disrespected a bullish fair value gap, and at the same time, created a bearish fair value gap. And clearly, those two are overlapping, which gives us our balanced price range. So as usual, we place our entry at that balanced price range. Our stop loss goes above the swing high, and for our target, we aim for a 1 to 2 risk to reward. Now, this is how the trade played out. Price came back into the balanced price range, respected it, and then moved strongly to the downside. Again, this comes back to context. We had a liquidity sweep, a reaction from a key level, displacement, and a clean, balanced price range. That's a complete story, and when you see setups like this, those are the ones you want to focus on. So to recap everything we've talked about, a balanced price range is simply the overlap between a bearish fair value gap and a bullish fair value gap. And that overlap creates a high probability area on the chart. But just because it's high probability doesn't mean you should go to your chart and start trading every single one you see. You need confluence. A balanced price range you want to trade from needs to have a story behind it. If not, it's just a pattern. And the more context you have around that setup, the higher your probability becomes. But at the same time, you also need to understand this. No matter how many confluences you have, you will still lose sometimes. That's part of trading. But when you have strong context, what that does for you is simple. You win more than you lose, especially when you're using proper risk to reward, like a 1 to 2 or even a 1 to 3. And that's where consistency comes from. So if this video made sense to you and you actually got value from it, go ahead, give it a thumbs up and subscribe. I'll see you in the next one.